A company is depicted as a cold, calculating machine focused solely on maximizing profit. The concept of ROI, return on investment, is introduced as the main driver of corporate decisions. A fictional company, Generic Corp, is introduced with an employee named Steve. Steve is shown working, representing a typical employee earning $40,000 a year. Generic Corp views Steve as an expense, paying his salary. Flashback to the 1980s. CFOs and insurance brokers discover a tax code loophole regarding life insurance cash value. A diagram shows the inside buildup of life insurance cash value. Generic Corp takes out a permanent life insurance policy on Steve. The company pays $10,000 a year in premiums for Steve's policy. The money in the policy grows over time, earning interest or dividends. A visual shows the tax-deferred growth of the policy's cash value. A comparison. Money in a standard investment account is taxed, but money in the insurance policy grows untouched by the IRS. Generic Corp borrows against the cash value of the policy to fund executive bonuses and operating costs. A visual explains that the interest on these loans was once tax-deductible. The company enjoys both tax-free growth and tax-deductible interest, creating a financial arbitrage machine. Years pass, Steve eventually dies. Regardless of when Steve dies, as long as premiums are paid, the policy is active. Upon Steve's death, Generic Corp receives a $300,000 death benefit. A visual highlights that life insurance death benefits are generally income tax-free. A recap of the math. The company parks cash in a tax-free asset, boosts its balance sheet, and receives a lump sum when an employee dies. The concept is compared to a high-yield savings account triggered by an employee's death. A moment of reflection. The company profits from the death of its employees. The concept of insurable interest is introduced, explaining that insurance can only be bought if a financial loss would occur. A scenario where someone tries to buy insurance on a stranger, creating a moral hazard. Question raised: how do companies justify insuring low-wage workers like janitors? The company argues that every employee contributes to the bottom line, justifying insurable interest. Courts and regulators allow the practice for decades. Transition to Part 2. The history of the janitor insurance craze. The practice explodes in the 1990s and 2000s among major corporations. A list of companies: Walmart, Disney, Procter & Gamble, Winn-Dixie, McDonnell Douglas shown as participants. Insurance brokers aggressively market the strategy to corporate boards. A broker pitches to a boardroom, insuring thousands of employees and profiting from actuarial mortality rates. A visual shows a workforce transformed into an actuarial table. The term dead peasant is introduced, referencing feudal society and how companies view low-level staff. A specific case: Winn-Dixie takes out COLI policies on 36,000 employees in 1993. Employees are unaware that policies are taken out on them. Winn-Dixie pays over $100 million a year in premiums. The IRS investigates and challenges the legitimacy of the transactions. The IRS accuses Winn-Dixie of using the policies as a tax shelter. A courtroom scene. The IRS takes Winn-Dixie to court in 2001. The judge rules against Winn-Dixie, stating the program is for tax avoidance. However, the judge does not ban the ownership of such policies, only the deduction of interest. The practice continues, but with adjusted financial strategies. A series of tragic stories brings the issue to public attention. Philippe Tilas, a Camelot Music employee, dies young. His family struggles with funeral costs. Camelot Music receives a $340,000 payout on Philippe's death. The family receives nothing. Walmart is revealed to have taken out policies on hundreds of thousands of employees. Louis Rice, a Walmart employee, dies. His widow receives nothing, but Walmart receives a death benefit. The family sues Walmart, sparking legal challenges. Courts begin to rule that companies lack legitimate insurable interest in low-level employees. Lawsuits lead to settlements. Walmart pays over $10 million in a class-action lawsuit. Other companies also pay millions in settlements. Despite the settlements, the practice of corporate-owned life insurance continues, with new rules. The narrator pauses the history lesson, shifting focus to the psychology behind executive decisions. A room full of executives sits around a table, appearing respectable and ordinary. The narrator wonders how these executives justify profiting from the deaths of their lowest-paid workers. A visual representation of abstraction in finance appears. a house labeled as real estate asset, a debt as receivable, and an employee as human capital. A spreadsheet fills the screen, replacing faces and names with numbers. Brokers discuss policies using dehumanizing terms like mortality tables and yield. The narrator warns about the danger of making decisions solely based on math, losing sight of morality. A business owner watches the lesson, reflecting on whether they see their team as people or as units of production. A visual comparison: employees as people versus employees as assets to be leveraged. A flashback to executives making decisions that resemble dead Peasant Insurance. A depiction of the massive incentives offered by the tax code encouraging these practices. The narrator emphasizes the recurring theme: incentives drive behavior. A government official creates a tax loophole, making it profitable to buy life insurance on janitors. Companies rush to buy life insurance policies on janitors, motivated by the new incentives. The narrator questions the lack of moral compass among the players in the system. Transition to Part 4, the current state. Nick appears, addressing the audience's question about whether these practices still happen. Nick explains that Congress passed the Pension Protection Act in 2006, a visual summary of the new rules: notice and consent, and highly compensated individuals. An employee receives a notice about a life insurance policy and signs a consent form. A chart shows that companies are now restricted to policies on the top 35% of highest-paid employees. A janitor looks relieved as the janitor insurance practice is shown to be largely gone. The narrator clarifies that COLI is not dead, but has shifted focus. A bank building is shown, introducing BOLI Bank-owned life insurance. A graph displays the staggering $180 to $200 billion held by U.S. banks and life insurance policies. Logos of J.P. Morgan Chase, Bank of America, and Wells Fargo appear, each holding billions in these assets. A bank executive explains that life insurance is a tax-efficient Tier 1 capital asset. A balance sheet is shown, strengthened by life insurance assets. Scene depicts a payout occurring when an employee dies. A mid-level manager at a bank is shown, unaware that the company has a policy on their life. A stack of onboarding paperwork is presented, with the consent form buried within. An employee quickly signs the paperwork, eager for the job and signing bonus. A close-up of the consent form. I consent to the company purchasing insurance on my life for the benefit of the company. The narrator explains that the policy can remain in force even after the employee leaves the company. A timeline shows an employee working at a bank for 3 years, then leaving for another industry. Decades pass, and the former employee dies. The bank receives a check, profiting from the death of the former employee. A ghostly image of the employee's past career hovers over the bank, symbolizing ongoing profit from mortality. The narrator reflects on the persistent nature of these policies and their moral implications. A montage of executives, brokers, and bankers continuing business as usual. A family mourns the loss of a loved one, unaware that a former employer profits from their death. A visual split: one side shows the grieving family, the other shows the bank receiving money. The narrator urges viewers to consider the human impact behind financial abstractions. A business owner contemplates the lesson, questioning their own practices. The narrator reiterates the importance of seeing employees as people, not just assets. A final warning appears. When you lose sight of humanity, you lose the moral plot. The narrator closes the lesson, leaving viewers with a sense of responsibility and awareness. Nick addresses the audience, acknowledging viewers typing comments. The viewer questions why company-owned life insurance matters if they're dead. Nick explains that this is a common objection and partially valid. Nick clarifies that a corporate policy doesn't prevent personal insurance. He prepares to explain why viewers should care about company-owned life insurance. Nick introduces the concept of opportunity cost of capital. Nick illustrates how company money spent on insurance could go into 401k matches. Nick points out that insurance premiums could have been used for salary increases. Nick notes that money could have been reinvested into better equipment or R&D. Nick summarizes that capital is being diverted from productive uses to insurance. Nick introduces the concept of moral hazard. Nick asks if viewers want to work for a company that profits from their death. Nick presents an extreme scenario. Company decides between safety upgrades or profit. Nick explains that insurance payouts can offset the cost of accidents. Nick questions if this financial incentive subtly affects company decisions. Nick clarifies he isn't accusing companies of malice, but warns of psychological risks. Nick states that insurance lowers the cost of tragedy for employers. Nick warns that this is a dangerous mindset for companies. Nick introduces the issue of privacy. Nick explains that companies share employees' medical data with insurance underwriters. Nick asks if viewers want employers analyzing their health data for profit. Nick transitions to actionable advice, what viewers can do. Nick emphasizes that his channel is about navigating the system, not just complaining. Nick presents Step 1. Check onboarding paperwork at new jobs. Nick advises viewers to read fine print for company-owned life insurance disclosures. Nick mentions the Pension Protection Act requires employee consent. Nick tells viewers they have the right to refuse consent. Nick explains that refusing consent prevents the company from taking out the policy. Nick acknowledges that refusing may make one unpopular. In HR, Nick asserts that it's worth it because it's your life and your name. Nick presents Step 2. Don't rely on work for life insurance. Nick describes the common mistake of relying solely on employer-provided life insurance. Nick explains that group life insurance is tied to employment status. Nick warns that losing a job or quitting means losing coverage. Nick points out the irony that companies keep their policy, but employees lose theirs. Nick urges viewers to get their own private term life insurance policy. Nick stresses the importance of owning and controlling your own policy. Nick presents Step 3. Understand the tax game. Nick explains that companies use life insurance for tax advantages. Nick suggests viewers can benefit from tax-advantaged growth too. Nick warns against whole life or universal life policies for most people. Nick recommends Roth IRAs and HSAs for tax efficiency. Nick encourages viewers to use the tax code wisely, without betting on death. Nick transitions to the bigger picture, the financial matrix. Nick explains the difference between the real economy and the financial economy. Nick describes the real economy as where people work, buy, and save. Nick describes the financial economy as a world where everything is an asset. Nick explains that in the financial economy, even death is an asset. Nick summarizes that dead Peasant Insurance shows finance's detachment from reality. It calls the system cynical and cold, but insists it's the reality we live in. Nick says the only way to win is to know the rules better than the companies. Nick encourages viewers to use the same strategies as corporations for their own benefit. Nick urges viewers to protect their own interests. Nick warns not to let employers care more about your death than you care about your life. Nick concludes by asking viewers to share the video if they found it shocking or informative. Nick notes that most people are unaware of Janitor Insurance and its ongoing impact. Nick says education is the only leverage people have. Nick invites viewers to check out resources on building a personal financial fortress. Nick encourages viewers to become the king or queen of their own financial castle. Nick thanks the audience for watching and promises to see them in the next video.